Hello, just going to talk you through the Unit 2 Finance for Business exam for tomorrow. Here's what your exam is. So it's an on-screen test, it's an hour long and there's 50 marks available to you. So, this is what we're doing it on. So there's 5 major financial tools. Break-even includes costs, of course. So I've categorised them into 2 things, planning tools and reviewing tools. So on the left hand side are our planning tools, so break-even, cash flow and budgeting. These are things that help you plan your year, your months, your business. And the facts are, don't forget, they haven't happened. You can see what might happen, you can see potential problems, and therefore you can adjust your plan. You can make your break-even as high or low as you want it. You can look when your cash flow money is coming in and out and when that's going to be a problem. You can look at how much you expected to spend on costs and see whether you've done that or not. Then you have your review tools, which are reviewing how successful you've been, and therefore you can need to react to them for the following year. So these just measure success at the end of a financial year, and they are real. They'll tell you how well you've done. So to put it in some context, a business has a strategy, which is basically where do you want to be, your objectives, where they want to be by the end of the year or in 5 years. Then they have where are we now, and then once you've worked that out, you go, well, how are we going to get to where we need to be? The income statement and statement of financial position, the profit and loss and balance sheet, tell you where you are now. There are a review, a statement of where you are as a business. At the end, when you want to judge how well you've done what you wanted to do, you use those 2 things to judge whether you've achieved your objective. So how do you get there? The strategy, the plan. You use these 3 financial documents to help you get to where you need to be. So, break even, what is it for? It's for planning how many units you need to sell to break even. That's all it is. It tells you exactly how many units you need to sell in order to make no profit or no loss. What does it look like? This chart here. Now, in the middle, where total revenue and total cost meet, that's our break-even point, and it tells us in quantity of units. We have our fixed cost line, and we have our margin of safety. Now, let's say break-even is 10, and we decide to produce 30 units. There's no point producing 10 because we won't make any money, so we're going to produce 30. That means we can afford to not sell 20 units before we start making a loss, which is this side. So what are the benefits and risks? And what I mean by this is what the benefits of doing break even and what are the risks if we don't. There here, look. Just pause it on there. You can have a look yourself. I won't explain that bit. So our next planning tool is cash flow. And this tells you 2 things. Predicting the flows of money in and out of your bank account. So how is your bank account each month affected by the money that goes in and out of your business? And predicting when the money goes in and comes out. I should say out, not in. So for instance, if you're a ice cream salesman, a lot of the time of the year you may have more money going out than you've got coming in. And so you need to know when your money is coming in. What does it look like? Like this. You have an opening balance, that's how much money you have in your bank at the start. You then have your sales coming in, the money coming in, inflows. Then you have all your money going out, your costs. Then you have your net cash flow, which is the difference between the money coming in and the money coming out. So this is negative. That says for month 1 then, I have more money going out than coming in. Now don't forget it's a prediction, so I know that's going to happen and I'm going to have a closing balance of this. Because what I do is take the opening balance, add it onto this. So I have a negative closing balance, so I need to do something about it, because that will be the negative balance of my next month. Then we do the same thing again, and it's negative again. So I know that I've got to fix this problem. And I can either do that by getting more sales in that month, taking money away from here, so trying to reduce my costs, maybe pay my fuel all in one go a few months later, try and get cheaper insurance, not do advertising then, anything like that, or get a loan or an overdraft to make sure I don't get a massive fine from the bank for going into negative numbers. So what's the benefits and risks of doing a cash flow? They're here. The risks are quite easy. All you got to think about is if you don't do this, how do you know when money's coming in and out? So for this instance, this is negative, but if I know money's coming in month 3, I'll be alright, because this might turn positive. If I didn't know that, I might be panicking. Our third planning tool is budgets. What is it for? Setting targets of spending and revenue. So all this is a bit like a cash flow, but you're trying to go in June or July, we're going to spend that much and we're going to receive that much money. So it's targets so everyone's motivated, know what you're trying to aim for. So here's the key points. It can forecast start costs, so you can try and work out what your budget is for setting up your business. You can get your budget for a new product or build a new factory, what your costs are going to be, what your revenue is going to be. Now budget control is slightly different. This is your plan here, your budget plan. Then your budget control is what do you do once you've made your plan? Well, you start doing your stuff, your activity, then you have an outcome, what's happened. Then you need to measure whether that outcome compares with what you planned to do in the first place. And if not, then you need to change your activity. So budget control just means reviewing your budget to make sure you are hitting your targets, and if you're not, what do you need to do to change them? So now we move on to our measures of success, how well we've done at the end of the year. So profit and loss, or the income statement, just tells you how much profit or loss you've made in a year. It looks like this. Dead simple. Total revenue, how much money you get in. Cost of sales, the things that cost you to make the product, such as materials and wages. You take them away, you have gross profit. Then you have overheads and expenses, things that are not related to making it but are still important, like marketing and rent and so on, called indirect costs, remember. And net profit. So profit and loss is really easy. You start at the top and you take everything away until you get to here. And the two things you're looking at is gross and net profit. Now the top half is called the trading account. So that just includes the three things. So what happens if this is negative? Well, this is negative. Well, the easiest thing to remember, even if you're not given a table, just picture the table in your head and think about, if this is negative, gross profit, I need to change these two things. I need to make more revenue, or I need to reduce my cost of sales. Net profit is negative, I need to increase my gross profit or reduce my expenses. It's that simple. So the other one is a statement of financial position, also called the balance sheet. What is this for? So this shows you two things: what a business owns and owes, assets, liabilities, and where the money has been invested from shareholders. What does it look like? This looks complicated, but it's not that hard. What do the words mean? They're there. Okay, so fixed assets is something you would keep for a year. Then you've got the current assets. So the word current means things you need to change into cash within a year. So here's the three things. Debtors is people that owe you money, cash and stock. Then you've got current liabilities, which is things you need to pay within a year. Creditors are people you owe, overdraft you owe to the bank. Net, as we know again, is the difference between these two things, which is called working capital. Now working capital is massively important, because what this means is if you go into debt and can't pay these off, the first thing you need to do is start to sell your current assets off. So in this case, look in year one, she's got net current assets of 4,050, which means she has more of these than she does these, which is great, which means if this is a problem, she can sell her stuff off to pay for it. Next year it's negative, which means she doesn't have enough assets to be able to pay her liabilities. So that means she could go bankrupt. At the end you have total assets, which is this, add fixed assets. And then you get that, which is the value of the company. Now the bottom half, draw a line under that, finance by shows you where the money's come from. So owner's capital, so that's money put in by the owner or the shareholders. Retained profit is money you've kept over years from the profit and loss account. And these two must balance. All these two added up. And that's very simply what a balance sheet shows you, what you own and what you owe. So to get a distinction, you need to be able to analyse both of those documents. So if you get one, these are the questions you should ask yourself. Has the firm made a healthy net profit? Has anything changed since last year? If the business is making a loss, then what can we do to improve it? The balance sheet, is there enough working capital to cover the debts, what I just said just? Is there enough cash to cover the immediate debts? Is there money saved as reserves to increase the shareholders' funds? If working capital is low, then how do we improve it? And those are what you're going to do to get a distinction. I'll talk you through some of those examples in the next video. Now remember that you have a OneNote you can look at. I'm going to show you now. You have a OneNote you can look at. In the Unit 2 exam, it tells you the overview, the content. It goes through each section. I've found some useful videos on YouTube, other than this one, some case studies, some excellent websites There's some past papers with some mark schemes you can look at. Okay, bye.